Imagine you buy a safe, reliable corporate bond.
Right, like a total cornerstone for your portfolio.
Exactly. It's paying a fixed 9% interest rate. You've, done your modeling, projected your cash flows, and you feel entirely secure in this asset.
Yeah, you're just waiting for those annual checks to roll in.
Right. But now imagine waking up one morning to find out the issuing bank has simply decided not to pay your interest this year.
Just out of nowhere.
Just out of nowhere. Not because they're bankrupt, but literally just because they don't want to.
Wow.
And furthermore, you learn that this skipped payment is gone forever. It doesn't compound, and you can't even sue them for default.
Yeah, which is terrifying for a fixed income investor.
It's a total nightmare. And then a market crisis hits, and your entire principal just, evaporates into thin air.
Yeah.
Legally wiped out, and there's absolutely nothing you can do about it.
It's basically the ultimate financial disguise.
It really is. So, welcome to a new deep dive on the Gap Advisors and AS Clinic podcast. We have a highly technical, incredibly high-stakes mission today.
Yeah, we are decoding what happens when a plain vanilla debt instrument is actually like a weaponized piece of equity in disguise.
Weaponized equity. I love that phrase. It's the ultimate Trojan horse of the balance sheet.
It really is. And, if you don't understand the complex accounting frameworks that unmask these instruments, you are carrying systemic risk without even realizing it.
Exactly. You're flying blind. Now, before we tear into the mechanics of this specific instrument, we need to establish the hard baseline parameters for today's deep dive.
Right, because precision is everything with these standards.
Exactly. So for this discussion, our functional and presentation currency is the Indian rupee, the INR.
Okay, got it.
And any other currency we might touch upon, just theoretically, is classified as a foreign currency. Plus, our reporting period runs strictly from the 1st of April to the 31st of March.
Perfect. And let me just quickly establish the regulatory boundaries here, too.
Go for it.
The views expressed in today's deep dive are the personal views of the author of our source material.
Right.
They are not binding on you, the audience.
Right. Definitely.
We're navigating highly complex, nuanced interpretations of financial standards here. So please, always seek the help of a qualified expert before taking or refraining from any action based on the views we discussed today.
Absolutely crucial disclaimer. So let's start with the big picture, the existential why. Why should you care about this?
Yeah, why does this matter to the everyday person?
Right. Whether you are an institutional portfolio manager, an audit partner, or even just a sophisticated retail investor, putting your hard-earned money into shares of a listed company, why care about esoteric accounting standards?
Well, there is this really dangerous tendency in the market to just look at the bottom line.
Oh, yeah. Pure EPS focus.
Exactly. People focus entirely on earnings per share, and they just assume the accounting department has everything neatly categorized.
And that assumption is, precisely how generational wealth gets wiped out during a liquidity crisis, right?
100%. I mean, accounting standards aren't just bookkeeping. They aren't merely a method of keeping score.
What are they, then?
They are the actual physics of the financial universe.
Yeah.
They dictate how reality is permitted to be presented to the public.
Wow, the physics of the financial universe.
Yeah. If an investor or even an auditor doesn't understand how a seemingly safe bond harbors these extreme hidden equity risks, they are totally flying blind.
So they're basically pricing in a risk premium for a bicycle while actually sitting on a motorcycle with no brakes.
That is the perfect analogy. It's a complete mispricing of risk.
You think you're senior in the capital structure getting your 9%.
Right, but the accounting reality might place you at the very bottom, right next to the common equity holders, just waiting to be wiped out.
Which is terrifying. And if a bank issues a hybrid financial instrument, the way they classify it, and consequently how the investor has to account for it, alters the whole risk profile.
It alters everything. Leverage ratios, reported volatility of earnings, all of it. If you don't speak this deepest dialect of accounting language, you cannot accurately read the risks.
And that dialect is incredibly complex, which is exactly why we aren't just relying on theory today.
No, we need hard, defensible logic for this stuff.
Right. When professional auditors and financial controllers hit a wall with these hybrid instruments, they don't just guess. They require documented logic.
Exactly.
And that brings us to the source material for this deep dive. We are extracting this case study directly from the issue repository on GotAdvisors.com.
Which is, frankly, an indispensable tool for anyone operating in the financial reporting ecosystem.
It really is. For those of you who might not know, GodAdvisors.com hosts an active repository of over 4,500 highly specific issues, along with their detailed technical responses on Ind AS and Indian GAAP.
Over 4,500, that's massive.
It's huge. And the best part is that any person can register for free, submit their own specific knotty issues on Ind AS or Indian GAAP, and get a detailed, technically rigorous response delivered right to their inbox.
Think about the value of that if you're an auditor. The regulatory scrutiny on audit files today is just merciless.
Oh, absolutely. The NFRA doesn't mess around.
Right. When the National Financial Reporting Authority reviews a file, they want to see the exact theoretical framework. They need standard-based justification for why a complex instrument was classified a certain way.
So having that inbox delivery of a resolved query is basically a defensible roadmap for your documentation.
Exactly. It means you aren't operating on an island.
Now, the specific issue we are dissecting today is just a masterpiece of technical analysis. It was actually featured in the 235th edition of the GAAP Advisors Task Weekly newsletter.
Oh, authored by C.A. Manish C. Iyer, right? The director of GAAP Advisors.
Yes, exactly. Published on LinkedIn. And there are over 230 editions published to date, which creates this massive library of precedent. It's an incredible resource.
And I'll note right now, if you are wrestling with a balance sheet that has these kinds of hybrid monsters on it, you can actually book a one-on-one consultation on your specific Ind AS and IFRS issues directly with the author, C.A. Manish C. Iyer.
Oh, really? Where do you book that?
Through his page on topmate.io. It's highly recommended.
That's great to know. And bringing up IFRS is actually the perfect segue for our global listeners today.
Right, because this applies outside of India, too.
Absolutely. While this specific response is meticulously mapped to the Ind AS framework, the Indian accounting standards, the foundational architecture is international.
So if I'm sitting in London or Singapore, this deep dive still applies to me.
Yes, 100%. If we strip away the localized nomenclature, there is virtually no difference between Ind AS and IFRS for the specific topic we are analyzing today.
Wait, no difference at all?
Well, the fundamental tests, the SPPI logic, the debt versus equity classification rules under Ind AS 32 and IFRS 9, they are identical.
Okay, good to know. The only, microscopic divergence is in how the issuer classifies foreign currency convertible bonds, which isn't even the focus of our case today.
Got it.
So therefore, if you're globally following the IFRS framework, this deep dive applies directly to you, provided the bonds are denominated in your company's functional currency.
That is a crucial piece of context. We're dealing with global financial physics here.
Right.
So let's bring this down to the actual instrument. Let's look at the contract that sparked this massive accounting dilemma.
Let's do it.
Okay, we have a scenario where Company A, an investor, has deployed capital into a bond. The term sheet looks incredibly seductive on the surface.
They always do.
They do. The bond pays a fixed interest rate of 9%. That interest is paid annually.
Okay, so far so normal.
Right. And it's perpetual, meaning it has no maturity date where the principal must definitively be repaid, but it features a call option exercisable after 10 years.
Let's pause and analyze that from a traditional fixed income perspective. A 9% fixed yield potentially lasting forever with a 10-year call.
To a corporate treasury desk looking for yield, this looks like a total home run. You lock in 9%. If interest rates drop, the 9% looks even better, right? And if the issuer exercises the call option in year 10, great. You get your principal back and you've enjoyed a decade of high-yield returns. It looks like a standard, slightly long-dated debt instrument.
It totally looks that way until you read the regulatory fine print, which completely upends the economic substance of the contract.
A hidden layer.
Yes. The source material highlights this critical reality. This is not a standard corporate bond. This instrument is explicitly classified as a Tier I bond under the Reserve Bank of India's Basel norms, the 2nd and 3.
Oh, Basel III.
Specifically, it references the Master Circular on Basel III capital regulations dated July 1st, 2015.
Okay, we need to unpack Basel III and Tier I capital because that is the engine driving this entire accounting nightmare.
Yeah, we have to go back to the 2008 global financial crisis.
Right. When regulators realized that banks were heavily leveraged with instruments that offered absolutely zero protection when the market crashed, taxpayers had to step in and bail out the banks.
Precisely. So the regulatory response to 2008 was Basel III, which fundamentally changed how banks are required to fund themselves.
They needed more shock absorbers.
Exactly. Regulators demanded that banks hold more loss-absorbing capital.
Huh?
They created these strict tiers: Common equity Tier 1 is true equity, the first line of defense.
But banks hate issuing common stock.
They despise it because it heavily dilutes existing shareholders and lowers their earnings per share.
Right.
So the regulators and the financial engineers compromised and created additional Tier 1, or AT1 capital.
And these 9% perpetual bonds are AT1 instruments.
Yes. In the eyes of the banking regulators, this bond acts as a structural part of the issuing bank's equity base. It helps the bank satisfy its mandatory capital adequacy ratio.
Okay, so it's a bond acting like equity.
Right. The entire regulatory purpose of this bond is to act as a shock absorber. If the bank suffers massive losses, this bond is designed to take the hit before the bank becomes insolvent.
Effectively protecting the depositors and the taxpayer.
Exactly.
So we have a massive structural tension here. Company A, the investor, thinks they bought a 9% debt instrument that sits safely in their fixed income portfolio.
Yeah.
But the issuing bank and the regulators view that exact same money as equity-like risk capital designed to be sacrificed if things go wrong.
That tension is exactly what Ind AS and IFRS have to reconcile.
Right.
How does Company A classify this schizophrenic instrument on their balance sheet?
Right. What are the rules?
Our source material poses the two ultimate questions. Question 1, does this instrument satisfy the SPPI test?
And question 2.
Question 2, if it fails the SPPI test, where does it live? Is it fair value through profit or loss FVTPL debt? Is it fair value through other comprehensive income FVTOCI equity? Or is it FVTPL equity?
Okay, that's a lot of acronyms. Let's take those one at a time, starting with the ultimate accounting gatekeeper, the SPPI test.
Yes, SPPI stands for solely payments of principal and interest.
Solely payments of principal and interest. Got it.
This is the foundational diagnostic tool under Ind AS 109, which governs financial instruments.
Okay.
To understand the philosophy behind SPPI, we have to look closely at paragraph B4.1.7a of Ind AS 109. The standard setters are essentially asking, does this instrument possess the economic substance of a basic lending arrangement?
And a basic lending arrangement means that the returns you generate, the interest, are compensation for very specific, limited economic factors.
Exactly. The standard is explicit here. In a basic lending arrangement, interest is primarily consideration for two things: the time value of money and credit risk.
Time value of money and credit risk.
Right. You're being paid because you gave up liquidity for a period of time, and you're being paid a premium based on the probability that the borrower might default.
Makes sense.
You might also get compensated for basic liquidity risk and administrative costs, plus a little profit margin. But that is it.
Just those basic things.
If the cash flows represent solely those things, the instrument passes the SPPI test, and you're generally permitted to measure it at amortized cost.
Amortized cost. That's the safe, boring, highly desirable accounting treatment, right? Where you just accrue the interest over time and you don't have to constantly revalue the bond based on crazy market swings.
Correct. It provides incredible stability to the investor's balance sheet and their profit and loss statement.
Okay, but let me put on the hat of an aggressive asset manager for a second.
Okay, let's hear it.
I look at this term sheet. It says fixed interest rate of 9%. 9% is mathematically calculated on the principal amount outstanding. By the literal definition of the English language, that is interest.
Right.
Why would anyone argue that a fixed 9% coupon fails a test looking for payments of principal and interest?
Because Ind AS 109 does not care about the labels the marketing department slapped on the term sheet.
Oh, they don't care at all.
Not at all. It cares about behavioral mechanics under stress. Our source text systematically dismantles the illusion of that 9% coupon.
Okay, let's dismantle it.
The analysis reveals 3 fatal deviations from a basic lending arrangement. Let's look at the first strike. Absolute discretion.
Wait, absolute discretion to do what? How absolute are we talking?
Completely absolute. Under the Basel III regulatory framework that governs these Tier I bonds, the issuing bank has the full, unencumbered right to cancel the payment of the 9% coupon at any time.
Just cancel it.
Yes. And here is the truly shocking part for a traditional fixed income investor. The cancellation of that payment is not considered an event of default.
Let me stop you right there because we need to emphasize how radical that is.
It's wild.
If a normal corporation issues a traditional bond and misses a coupon payment by even 1 day, the rating agencies downgrade them to D for default.
Oh yeah, instantly.
The bondholders trigger cross-default clauses on the company's other debt. The lawyers file injunctions to seize assets. It is a catastrophic company-ending event.
It triggers immediate bankruptcy proceedings in many jurisdictions. But with this AT1 bond, the bank's board of directors can just sit down on a Tuesday, look at their capital ratios and say, you know what, let's conserve cash. We aren't paying the 9% this year.
And legally, the investor can do absolutely nothing.
Nothing. They cannot sue. They cannot force liquidation.
Wait, if the bank has the absolute right to skip payments without defaulting, how is that risk even priced in? That completely alters the fundamental nature of the credit risk the investor is taking.
Completely.
You aren't just taking the risk of bankruptcy, you are taking the risk of the issuer simply changing their mind based on their internal regulatory metrics.
That is exactly the point Ind AS 109 is making. That level of behavioral volatility is completely inconsistent with a basic lending arrangement.
Wow.
But it gets dramatically worse.
Let's look at strike two. Strike two. What happens to the money they skipped? Like, do they pay it back later?
That is strike two. The coupon is explicitly non-cumulative.
Non-cumulative meaning?
The source points out that if the bank exercises its absolute discretion and cancels the payment, that money is not deferred. It is not placed into an escrow account. It is forfeited entirely.
It just evaporates.
It evaporates.
So there is no IOU. You don't get a huge balloon payment at the end of the bond's life to make up for the missed years.
Zero. And this is where we get into the heavy mathematical theory of the accounting standard. Because it is non-cumulative, the investor does not earn interest on the unpaid interest.
Right.
This is a direct, undeniable violation of the time value of money concept required by the SPPI test.
Okay, let's break that down for the financial modelers listening. The time value of money dictates that if cash flows are delayed, the yield must increase to compensate for the extended duration, right?
Yes.
In a standard bond, if a payment is deferred, the interest continues to compound on the new, higher principal balance.
Precisely. The compounding mechanism is what protects the time value of money. But here, if the bank skips year 3, year 4, and year 5, your capital has been locked up for 3 extra years with zero compensation for that passage of time.
That's brutal.
The fundamental duration risk profile of the instrument is destroyed. The cash flows you might eventually receive in year 6 are not providing consideration for the time value of money for the preceding 3 years.
So it's failing the basic test.
Therefore, it is economically impossible to argue that the returns are solely payments of principal and interest.
You know, it's essentially behaving exactly like a silent equity partnership with no upside participation.
That's exactly it.
Because a common stock dividend is discretionary, and if a company skips a dividend, it's non-cumulative. You don't get last year's dividend this year.
You're hitting on the exact philosophical transition the standard setters made. The mechanics of the coupon mimic an equity dividend perfectly.
It really does.
But before we cross into the equity discussion, we have to finalize the SPPI failure with strike 3, the illusion of the call option.
Ah, right, the 10-year call option. The marketing brochure probably highlighted that as a great exit strategy. Don't worry, you'll get your money back in 10 years.
Yeah, well, the source text severely clarifies the reality of that call option. The querist noted, and the standard confirms, that this option rests solely and exclusively with the issuing bank.
The investor has no say.
The investor has no put option. They possess absolutely no contractual right to demand their principal back after 10 years or 20 years or 50 years.
So the investor is permanently trapped while the issuer holds the keys.
Exactly. And let's look at corporate finance theory. When will a bank actually exercise a call option on a 9% bond?
Well, only when it's economically advantageous for the bank, right?
Right.
Like if prevailing market interest rates drop to 5%, the bank will exercise the call, pay back the principal, and issue new AT1 bonds at 5%. But if market rates spike to 12%, the bank will absolutely refuse to call the bond, and the investor is permanently stuck earning a below-market 9% yield on capital they can never retrieve.
And that asymmetrical optionality further corrupts the SPPI profile. The cash flows are dependent on the issuer's future cost of capital, not just basic credit risk and time value.
Man, it's rigged.
So when you synthesize these 3 strikes, absolute discretion to cancel, the permanent forfeiture of non-cumulative coupons, and the perpetual trap of an issuer-only call option, the conclusion is inescapable.
It fundamentally fails the SPPI test.
It fails spectacularly. The source is definitive, stating, and I quote, "Thus, the cash flows of the bond are not consistent with a basic lending arrangement. Therefore, such bonds do not give rise to cash flows on specified dates that are solely payments of principal and interest."
So we bring down the gavel on the SPPI test. It fails. What is the immediate accounting fallout for Company A? Like, where does this asset go on their books?
The fallout is severe and immediate. Because it fails SPPI, The door to amortized cost is permanently locked.
It's slammed shut.
Yep. We looked at paragraph 4.1.4 of Ind AS 109, which are source cites. This paragraph establishes the default penalty box for complex financial instruments.
It's penalty box.
It states that any financial asset failing the SPPI test must, by default, be measured at fair value through profit or loss or FVTPL.
Okay, we really need to drill into the mechanics of FVTPL because that acronym strikes terror into the hearts of corporate treasurers everywhere.
It really does.
FVTPL means that at every single reporting period, every quarter, every year end, the investor must calculate the current fair market value of this highly illiquid, highly complex bond.
And fair valuing an AT1 perpetual bond is a complete nightmare.
How do you even do it?
You have to run complex Monte Carlo simulations to price the probability of the bank skipping a coupon. You have to factor in massive credit spread volatility.
And the brutal part is the profit or loss aspect. If the fair value of your bond drops by 20% this quarter because the market is panicking about the banking sector, that 20% unrealized loss doesn't just sit quietly on the balance sheet.
No, it does not.
It flows directly into your company's P&L statement as a recognized expense.
It destroys your reported net income. It creates these wild, unpredictable swings in your earnings per share, entirely decoupled from your actual core business operations.
It's crazy. Company A thought they bought a boring 9% bond, and now they have a highly volatile derivative swinging their quarterly earnings by millions of rupees.
This is the exact scenario CFOs lose their jobs over.
Absolutely. But as our deep dive outline suggests, just when you think Company A is doomed to the FVTPL nightmare forever, there is a potential escape hatch hidden deep within the accounting standard.
There is an escape hatch.
But accessing it requires answering one of the most heavily debated questions in all of corporate finance. We have to figure out, is this instrument fundamentally a liability, or is it equity wearing a debt disguise?
This represents the crucial transition in our analysis. We are leaving the measurement standard of Ind AS 109 and entering the presentation standard. In AS 32, financial instruments. Presentation. And before we even look at the rules, I want to emphasize a vital caveat from the source material. The text explicitly warns that classifying such an instrument as either equity or liability requires significant professional judgment.
I've always found that phrase, significant professional judgment, to be the standard setter's way of admitting, look, we know the real world is infinitely complex, and we cannot write a rigid rule for every single scenario.
Oh, that's exactly what it means.
It places a massive burden on the auditor and the preparer to look past the legal form and define the true economic substance.
It's an immense burden. And because it relies on subjective, deeply analytical human judgment, the framework demands radical transparency.
Transparency in the disclosures, you mean?
Yes. Paragraph 122 of Ind AS 1 requires that the exact logical path used to reach this judgment must be clearly and comprehensively disclosed in the notes to the financial statements. You cannot just pick a classification in a black box.
You have to defend your homework.
You have to defend it to the regulators, the shareholders, and the entire market.
So let's build that defense right now. Let's apply our professional judgment. How do we decode Ind AS 32 to determine if this Basel III AT1 bond is a liability or an equity instrument?
We begin with the foundational bedrock, paragraph 16 of Ind AS 32.
Paragraph 16, okay.
This paragraph provides the structural definition of an equity instrument. It states that an instrument is an equity instrument if and only if certain strict conditions are met.
What's the biggest hurdle?
The absolute most critical condition, the hurdle that destroys most hybrid instruments, is that the instrument must include no contractual obligation to deliver cash or another financial asset to another entity.
No contractual obligation. We have to interpret the word obligation very strictly here, right?
Very strictly.
Let's take our schedule to the 9% AT1 bond and apply paragraph 16. Let's look at the principal amount first. Does the issuing bank have a contractual obligation to return the principal cash to the investor?
Let's follow the timeline we established. It is a perpetual bond. There is no maturity date.
Yeah.
The 10-year call option is solely at the discretion of the issuer. The investor cannot force redemption. Therefore, the source correctly concludes that the issuer has an obligation to redeem the principal only upon the liquidation of the bank.
Only when the bank is fundamentally dead, like going through bankruptcy proceedings and its assets are being liquidated and distributed.
Correct. And under accounting theory, an obligation that only arises upon liquidation does not violate the equity definition because common stock also represents a claim on assets during liquidation.
Right. Common shareholders only get paid out in liquidation after everyone else. So on the principal front, it looks like equity.
It does. Now, let's look at the interest component, the 9% coupon.
Does the bank have a contractual obligation to deliver the 9% cash every year?
As we established during the SPPI test, the bank has absolute, unencumbered discretion to cancel the coupon payment at any time without triggering a default.
So no obligation.
Therefore, there is zero contractual obligation to deliver that cash.
It is entirely a voluntary distribution of capital.
Exactly. The source draws a brilliant, clarifying parallel here. It states that the obligation to pay the coupon arises only when the issuer actively decides to make the payment.
Right.
This mechanical reality makes the 9% coupon behave exactly like a dividend on ordinary common equity shares.
Because a corporation is never legally forced to declare a common dividend, right? The board of directors chooses to declare it based on available distributable profits.
Spot on. So if we synthesize this under the strict lens of paragraph 16, the bank only has to pay the principal when it ceases to exist, and it only pays the interest when it voluntarily chooses to do so.
So there's no enforceable contractual obligation to deliver cash while the bank is a going concern.
None.
If we stop the analysis right here, the conclusion is shocking but legally sound. This bond is actually an equity instrument.
If the Ind AS 32 rulebook ended at paragraph 16, every single AT1 bond in the world would be classified as equity, and the accounting would be very simple.
It doesn't end there, does it?
No. As you alluded to earlier, there is a massive plot twist in the standard, and that twist is engineered specifically to address the complex regulatory nature of Basel III capital.
Where is the twist?
We've moved down the page to paragraph 25 of Ind AS 32.
What does paragraph 25 introduce that blows up our clean equity classification?
Paragraph 25 introduces the highly complex concept of contingent settlement provisions.
Contingent settlement provisions.
It specifically addresses financial instruments that require the issuing entity to deliver cash or another financial asset, or otherwise settle it in such a way that it would be a financial liability in the event of the occurrence or non-occurrence of uncertain future events that are beyond the control of both the issuer and the holder.
Let me try to translate that into corporate finance reality. Uncertain future events beyond their control. So this isn't about the board of directors making a discretionary choice.
No, not at all.
This is about external triggers, like if a major stock market index crashes by 30%, or if sovereign interest rates invert, or, wait, in the specific case of banks, if their regulatory capital ratios drop below a legally mandated minimum threshold.
Yes, that last scenario is the exact mechanism that governs Tier 1 capital. Basel III regulations require these AT1 bonds to have a pre-specified objective trigger point.
Like what?
For example, if the bank's common equity Tier 1 ratio falls below 6.125%, a regulatory alarm bell rings, and the loss absorption mechanism built into the bond automatically activates.
And crucially, the bank dropping below that 6.125% ratio is considered an event beyond the control of the issuer. Even though the bank managers run the bank, a massive macroeconomic shock that destroys their loan book and vaporizes their capital is deemed an uncertain future event outside their absolute control.
Exactly. The standard setters take the view that no bank intentionally triggers its own insolvency mechanisms. Therefore, the trigger is a contingent event beyond their control.
That makes sense.
And because this trigger exists, paragraph 25 says, hold everything. We cannot just look at the discretionary payments. We must look at what happens when the doomsday trigger is hit. How does this instrument settle under extreme stress?
Which forces us to look microscopically at the loss absorption mechanics. When that regulatory alarm bell rings, what actually happens to the investor's billions of rupees?
This is the ultimate fork in the road for our entire deep dive. The accounting classification completely diverges based on the exact contractual mechanism used to absorb the bank's losses.
Okay, lay it out for us.
Our source material elegantly outlines the two dominant scenarios in the global markets. We need to analyze scenario A and scenario B because the difference between them is the difference between accounting salvation and accounting hell.
Let's walk down scenario A first. What happens when the trigger is hit in this version of the universe?
Scenario A involves what the market calls a CoCo bond. CoCo stands for Contingently Convertible.
Contingently Convertible. Walk me through the mechanics of a CoCo trigger.
Under a CoCo structure, the moment that pre-specified objective trigger point is breached, the moment the bank's capital drops below the minimum, the bond is immediately, mandatorily, and irreversibly converted into common equity shares of the issuing bank.
Whoa. So Company A, the investor, goes to sleep on a Friday night holding a senior-looking debt instrument with a 9% yield.
Right.
Over the weekend, a massive financial crisis hits. The bank's capital drops, the trigger is breached. Company A wakes up on Monday morning and their bond is just gone.
It's gone.
In its place, their brokerage account is suddenly filled with millions of ordinary common shares in a bank that is currently in the middle of a death spiral.
That is the exact brutal reality of a CoCo bond. It is designed to instantly deleverage the bank by vaporizing debt and replacing it with equity, saving the bank from immediate bankruptcy.
Incredible.
But now, let's analyze the accounting reality of that conversion under Ind AS 32. We have to ask, is the obligation to convert into shares an equity feature or a liability feature?
Wait, if it converts into shares and shares are equity, shouldn't the instrument be classified as equity from day one? It literally transforms into common stock.
It seems intuitive, but the accounting standards reject that logic violently.
Really? Why?
This is where we have to explain the philosophy of why. In AS 32 is incredibly strict about what constitutes true equity. If an issuer is obligated to settle an instrument by delivering a variable number of its own equity shares to equal a fixed monetary amount, the standard mandates that the instrument is a financial liability.
We really need to dwell on the word variable here. Why does a variable number of shares destroy the equity classification?
Because of the economic substance of the transaction. True equity represents a fixed residual interest in the net assets of the company. If you own 1% of the shares, you own 1% of the upside and 1% of the downside.
Right.
But in a CoCo conversion, the investor is essentially owed a fixed monetary value, say a 100 crore rupee principal amount. If the bank's stock price crashes to 10 rupees a share, the bank has to print and deliver 10 crore shares.
Oh, I see where this is going.
If the stock crashes to 1 rupee a share, the bank has to print 100 crore shares.
Ah, the bank is essentially using its own stock as a printing press, like a secondary currency, to pay off a fixed monetary debt. They aren't granting you a true ownership stake from the start. They're just settling a liability using highly dilutive paper instead of cash.
That is a brilliant articulation of the standard setter's logic. Because the bank is using a variable number of shares as a currency substitute to settle a fixed obligation, it does not evidence a residual interest.
So it's still a liability.
The economic substance remains a liability. Therefore, under Scenario A, the CoCo bond is classified as a financial liability by the issuer.
And if it's a liability for the issuer, what is the conclusion for Company A, the investor?
The conclusion is devastating. Because the issuer classifies it as a liability, the investor must classify it as a debt instrument. And let's remember where we were 20 minutes ago. This debt instrument categorically failed the SPPI test.
Right, because of the absolute discretion and the non-cumulative skipped payments.
Precisely. Because it is a debt instrument that fails SPPI, the investor has absolutely no choice. They are permanently locked into the penalty box. They must classify and measure this CoCo bond at fair value through profit or loss, FVTPL.
And we're back to the nightmare. Every time the market gets nervous about the banking sector, the fair value of this CoCo bond drops, and millions of rupees in unrealized losses flow directly into Company A's P&L, destroying their reported earnings. There is no escape.
None. Under a CoCo structure, you are trapped in FVTPL volatility. But the source provides us with Scenario B. And Scenario B is where the accounting mechanics produce an outcome that seems almost paradoxical to a layperson.
Let's explore the paradox of Scenario B. If it's not a CoCo bond, what is the alternative loss absorption mechanism?
Scenario B relies on a write-down mechanism.
A write-down. Walk me through the mechanics of a write-down when the alarm bells ring.
In a write-down scenario, the bank hits the exact same pre-specified regulatory trigger point. Capital drops below 6.125%. But instead of giving the investor a variable number of shares, the bond's principal value is simply mathematically written down to absorb the bank's losses.
Written down, meaning the bank just takes an eraser to the ledger and deletes the debt.
Essentially, yes. Depending on the severity of the capital shortfall, it could be a partial write-down, say, reducing the principal from 100 crores to 50 crores, or it could be a total permanent write-down to absolute zero.
To zero.
The liability is simply extinguished. The investor's money is used to plug the hole in the bank's balance sheet, and the investor receives absolutely nothing in return. No cash, no shares, nothing.
That is staggering. I mean, we saw real-world parallels to this recently in the global markets where massive multi-billion-dollar tranches of AT1 bonds were literally wiped to zero over a weekend to facilitate a bank rescue.
Yes, exactly.
And the common equity holders actually retained some value in that rescue. It is the ultimate financial vaporware. If I'm the investor, instead of waking up with shares in a failing bank, I wake up and my asset simply ceases to exist.
Yes, it is the most brutal realization of risk in modern finance. But now we have to look at the accounting reality of that disaster.
Okay, let's look at the accounting.
We have to take the write-down mechanism and apply paragraph 16 of Ind AS 32. In this write-down scenario, what is the issuer's contractual obligation to deliver cash or a financial asset?
Okay, let's think. We established earlier that their only technical obligation was to pay the principal upon liquidation of the bank.
Right.
But if the trigger is hit while the bank is still a going concern and the principal is written down to zero, then when the bank eventually liquidates, their obligation to deliver cash is zero.
Exactly. You've hit the theoretical bullseye. The source text, quoting the nuanced application of the standard, lays this out perfectly.
What does it say?
It states, if the bond provides for extinguishment of liability rather than conversion to common shares, the issuer has obligation to deliver cash only on liquidation, and that too not a fixed amount, but an amount after absorption of losses, which could be NIL.
NIL, meaning zero obligation.
And furthermore, because the bond just evaporates, there is no obligation to deliver a variable number of shares to compensate the investor. It completely escapes the paragraph 25 trap that caught the CoCo bonds.
So, because the bank's only obligation is to pay out whatever is left after a potential total wipeout, and they don't have to print shares to cover the difference?
Legally, structurally, and technically under Ind AS 32, this instrument qualifies as an equity instrument.
That is absolutely mind-blowing. The very mechanism that makes this bond infinitely more dangerous to the investor, the mechanism that completely destroys their principal without even offering the cold comfort of diluted shares in return, is the exact mechanism that legally transforms the instrument into equity.
It is a brilliant example of how accounting logic follows economic substance rather than emotional fairness. It is equity because it acts as the ultimate residual shock absorber, taking losses without creating a secondary liability.
And that brings us to the ultimate conclusion for the investor under Scenario B. Because the write-down AT1 bond is classified as an equity instrument, what happens to Company A's balance sheet?
They are thrown a massive regulatory lifeline. Under Ind AS 109, when an investor holds an investment in an equity instrument that is not held for trading, they are granted a special privilege.
A privilege? What is it?
They may make an irrevocable election at initial recognition to measure this investment at fair value through other comprehensive income FVTOCI.
Okay, we need to spend some time unpacking why FVTOCI is the holy grail for a corporate investor holding a volatile asset. Let's do a theoretical walkthrough. Why does a CFO desperately prefer FVTOCI over FVTPL?
Because it completely insulates their primary performance metric, the profit and loss statement. Let's look at a 3-year market cycle. You hold this write-down AT1 bond. In year 1, the market panics. The fair value of your bond drops by 30 crores.
Okay.
Under FVTPL, your company reports a 30 crore loss on your income statement. Your EPS crashes. Shareholders are furious.
Even though it's just a paper loss and you haven't even sold the bond?
Exactly. But under FVTOCI, that 30 crore drop completely bypasses the profit and loss statement. It is routed directly to the equity section of the balance sheet, sitting quietly in a separate reserve called Other Comprehensive Income.
Oh, wow.
Your reported net income for the year is completely unaffected. Your EPS remains completely stable.
And what happens in year 2 when the market recovers and the bond's value shoots back up by 20 crores?
Under FVTPL, you recognize a massive 20 crore gain in your P&L, making your earnings look artificially inflated. But under FVTOCI, that 20 crore gain just quietly increases the reserve in the equity section. The volatility is entirely quarantined away from the income statement.
It is a massive difference. Let's do a comprehensive recap of this entire journey because the logic chain is astounding. You are an investor. You start with a term sheet that says 9% fixed perpetual bond. To a layman, it's a bond.
But you put it through the Ind AS 109 SPPI test.
Right. And it fails immediately. It fails because the bank has absolute discretion to cancel the interest, the skipped interest doesn't compound, which violates the time value of money, and the investor has no right to demand their principal back. Because it fails SPCI, it is headed straight for the extreme volatility of FVTPL accounting.
Correct. the default penalty box.
But then you invoke significant professional judgment under Ind AS 32 to ask, is it actually debt or equity? You have to look at the Basel III disaster scenarios. If, during a regulatory crisis, the bond transforms into a variable number of shares, a CoCo bond, it is legally settling a fixed debt with stock.
Yes.
Therefore, it remains a liability, it is debt, and you are permanently stuck in the FVTPL nightmare.
Exactly right. The variable share settlement traps it as a liability.
But if, during that exact same crisis, the bond simply extinguishes and evaporates to absorb the losses, a write-down mechanism, the issuer has no obligation to deliver anything. It is legally equity.
Yep, it's equity.
And because it is legally an equity instrument, you earn the right to make the irrevocable election to classify it as FVTOCI, forever protecting your profit and loss statement from the valuation swings.
You have synthesized the entire complex framework perfectly. It demonstrates how the exact contractual wording of a disaster scenario, a scenario that may only have a 1% chance of ever happening, entirely dictates the everyday, quarter-by-quarter accounting presentation of a multi-million-dollar asset.
It is truly the hidden physics of finance. And walking through this exhaustive logic chain leaves me with a very provocative final thought for you, our listener, to mull over.
I'd love to hear. This is exactly why we do these deep dives.
So we have just spent all this time discussing how the Ind AS and IFRS accounting standards require this incredible level of deep, nuanced, paragraph-by-paragraph professional judgment to classify just a single AT1 bond. It requires human beings debating the nature of control, the philosophy of contingent events, the time value of money, and the fundamental economic difference between a principal write-down and a variable share conversion.
It is highly analytical, deeply philosophical work that requires an understanding of both law and economics.
So here's my question. If it takes that much human judgment and regulatory mapping to understand what an instrument truly is, how incredibly vulnerable are the massive, automated, algorithmic trading systems operating in the market today?
Oh, wow.
We have high-frequency computer programs buying and selling thousands of these complex Tier I instruments in milliseconds, providing liquidity to the market. Are those machines truly parsing the prospectus to understand the write-down versus conversion risks? Are they analyzing Ind AS 32, paragraph 25?
That is a genuinely chilling systemic question.
Right. Or are the algorithms just scanning the ticker, seeing a 9% yield, classifying it as fixed income, and blindly trading what they think is a simple golden goose?
If the algorithms driving global liquidity are merely parsing superficial data fields yield, call date, credit rating, and missing the deeply buried structural realities of loss absorption, we could be looking at massive, unpriced systemic blind spots.
Exactly.
When the next crisis hits and a trigger is breached, the algorithms might expect a standard default recovery process, only to find the asset has simply been erased. It underscores exactly why the human element, the rigorous professional judgment demanded by frameworks like Ind AS and supported by repositories like Gap Advisors, is so utterly vital to the true stability of our financial reporting ecosystem.
It's definitely something to think about the next time you see the fixed income markets moving at the speed of light. Well, that brings us to the end of our journey today. I want to sincerely thank you, our audience, for spending your time diving deep into the Gap Advisors Ind AS Clinic today.
Yes, thank you all.
We know these are highly dense, complex topics, but your dedication to understanding the underlying reality of the financial world, rather than just trusting the surface-level labels, is what makes this entire profession function.
We truly appreciate you joining us as we navigate these incredibly complex regulatory architectures.
If you extracted value from our discussion today, please do us a massive favor and follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. You can find us on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to the Gap Advisors Ind AS Clinic podcasts on. Hitting that subscribe button is the best way to ensure you never miss our technical deep dives.
And please take a moment to share this specific deep dive. Send the link to your contacts, your professional colleagues, and especially the members of your audit and finance teams who wrestle with these instruments daily.
Yes. And I want to give a very special shout out to any students out there who are currently rigorously pursuing their CA course. Sharing this deep dive with your peers helps spread vital, practical knowledge on the real-world application of Indian accounting standards.
It's so important for them.
This isn't just the textbook theory you memorize for an exam. This is how the real, multi-billion-dollar battles are fought on corporate balance sheets every single day.
Absolutely. The more professionals who truly understand the language of financial reality, the stronger and more resilient our entire financial system becomes.
And as one final reminder, if you find yourself staring at a term sheet that makes no sense, or facing your own complex accounting puzzles, remember you don't have to solve it alone. You can book a one-on-one consultation regarding your specific Ind AS and IFRS issues directly with the author of today's masterful source material, CA Manish C. Iyer.
Yes, you can reach him and book a session via his page on topmate.io. It's an incredible resource to have access to that level of standard-setting expertise.
It really is. So until next time, remember, when someone in a suit shows you a clean, simple financial term sheet and promises you a safe, predictable 9% yield, always, always ask to read the regulatory fine print.
And always rigorously question what exactly happens to your money when the doomsday trigger is pulled.
Thanks for joining the deep dive, everyone. We will see you next time.